Okay, so I want you to picture this. Imagine your car is worth exactly $15,000 on the open market.
Okay, I'm picturing it.
So tomorrow, through just completely terrible luck, it gets totally destroyed in an accident. Completely totaled.
Oh, man.
Right, but then the next day, you open your mail, and your insurance company has just cut you a check for $30,000. I
Wow.
mean, you just made a literal 100% profit on a car crash. That sounds like hitting the absolute jackpot, doesn't it?
I mean, yeah, it seems fantastic for you in that exact, isolated moment. But if that actually happened in the real world, like
Right.
if insurance companies just routinely paid out double the value of a loss, the entire global insurance system would just collapse overnight.
Because everyone will want to get into an accident.
Exactly. We would basically be turning minor traffic accidents into winning lottery tickets.
And preventing that total systemic collapse is exactly what we are here to explore today. So welcome to this special insurance study companion deep dive.
Glad to be here.
Our mission today is to really unpack one of the most foundational principles of property and casualty insurance. And I mean, whether you were staring down the barrel of a CPCU exam, or maybe you're starting out as a new claims adjuster, or honestly, you're simply trying to decipher the logic behind your own monthly premiums.
Which can be confusing, yeah.
Very confusing. Grasping this single concept really unlocks the machinery behind almost every policy you will ever encounter. And it's called the principle of indemnity.
Yes, indemnity, which is, at its absolute most basic level, the principle dictates that an insured person should be restored to approximately the same financial position they were in right before a covered loss occurred.
So exactly where they were, no better, no worse.
Right. The crucial mechanism here, like the engine that makes the whole rule work, is that you must be restored without making a profit.
Okay.
Insurance compensates for actual losses. It is structurally, fundamentally forbidden from creating financial gain.
So it acts like a financial reset button, basically. You get pushed back to 1 second before the disaster struck.
That's a great way to look at it.
So if you drop an $800 smartphone and it just shatters into pieces, indemnity dictates that your insurance pays to repair or replace it so you possess an $800 phone again.
Exactly. They do not hand you $2,000 to go buy the newest, high-end model and let you pocket the change.
Right. But, okay, let's look at this from a consumer's perspective for a second. Because when normal people hear a phrase like, we only pay exactly what you lost, the immediate reaction is often deep suspicion.
Oh, absolutely.
It just sounds like a built-in legal excuse for insurance companies to, nickel and dime claims and avoid paying out more money.
And that suspicion is entirely natural. People feel protective of their property. But indemnity is not about insurers being cheap. It's actually the mechanism that keeps the entire concept of insurance fair.
Fair for everyone else, you mean?
Right. Think about the fundamental social contract we are engaging in here. Insurance is, at its core, just a giant collective pool of money. Millions of people chip in a little bit of premium every month to protect each other from catastrophic, unexpected losses.
Right. The premiums build the pool.
Yeah, so if one individual pulls out more money than they actually lost, they aren't taking money from some faceless corporation. They are directly draining the collective pool that belongs to everyone else. So indemnity essentially forces the scales to stay balanced.
Okay, so if this is a fundamental rule, keeping that collective pool balanced, it must dictate how these companies actually build and price their products long before a claim ever even happens.
Oh, it dictates absolutely everything. It creates this massive domino effect across every single department, and it really starts with underwriting.
So the people deciding who gets a policy in the first place.
Exactly. Before a policy is ever issued, underwriters are evaluating the risk. And indemnity is the ironclad rule that prevents applicants from intentionally overinsuring their property.
Like trying to insure that $15,000 car for $1 million.
Right. You literally cannot do that. The underwriter will reject that application immediately because they know indemnity legally caps the payout at the actual loss anyway. It ensures the policy acts as a protective shield rather than, a speculative investment.
Which has to be the only way the pricing models actually function, right?
Yeah.
Like if payouts are strictly limited to the actual loss, actuaries can use historical data to mathematically predict what premiums we all need to pay to keep the pool solvent.
Yeah, let's actually look at the math behind that, because this is where indemnity becomes mathematically essential to the survival of the entire industry. Actuaries base their pricing on standard deviation and expected historical losses.
Okay, statistics.
Right. And if people could consistently profit from a claim, it would introduce just wildly unpredictable variables into those calculations. Removing the possibility of profit mathematically shrinks the standard deviation of risk.
So actuaries know the absolute ceiling of their exposure.
Exactly. If insurers had to price in the possibility of people treating insurance claims like slot machines, I mean, the premiums charged to the public would just skyrocket to cover that unpredictable
So
variance.
we'd all be paying for it.
Yeah. Indemnity is literally what keeps insurance premiums affordable for the average person.
And that unpredictability ties directly into human behavior too, doesn't it?
Yeah.
I mean, if I knew I could make a $50,000 profit from my house catching fire, my incentive to replace the batteries in my smoke detectors drops to absolute zero.
Oh, totally.
I might even start leaving candles burning near the curtains just to see what happens.
And you were describing moral hazard, which is a really critical concept here. Moral hazard occurs when people act more recklessly or even intentionally cause damage because they are shielded from the consequences,
Yeah.
or, in a non-indemnity world, actually rewarded for the damage.
Because they stand to gain something.
Right. Without the strict enforcement of indemnity, insurance ceases to be a safety net. It literally becomes a casino where people are placing bets on their own property being destroyed.
And if that happens, you end up with adverse selection, right? Where the only people actually buying insurance are the ones actively planning to have an quote-unquote accident.
Exactly. And that triggers what economists call a death spiral.
Ooh, death spiral.
Yeah.
Sounds intense.
It is. Because the premiums go up to cover the rampant fraud, right? So
Yeah.
the honest people drop their policies because they can no longer afford them.
And they aren't planning on burning their house down anyway.
Right. Then premiums have to go up again to cover the remaining bad risks until the entire system just goes bankrupt. Regulators mandate indemnity specifically to prevent this death spiral. It stops fraud, it protects the consumer pool from rate hikes, and it basically maintains the stability of the global market.
Okay, so the theory makes complete sense. Prevent profit, stop fraud, keep premiums stable. But when the rubber meets the road, someone actually has to enforce this.
Yeah.
Like when I take my wrecked car to a mechanic or when a tree falls on my roof, how does a claims adjuster translate this, overarching philosophy into a final payout check without overpaying?
Well, adjusters use a specific toolkit of policy provisions to basically enforce the math. And the most prominent tool in that kit is actual cash value, or ACV.
Okay, ACV. I've seen that on my own policy.
Yeah. ACV is how we factor in depreciation. So, say a windstorm destroys your 20-year-old roof. The adjuster is not going to buy you a brand new roof.
Why not? I need a roof.
Because you already consumed 20 years of the old roof's useful lifespan. To give you a brand new one today would put you in a significantly better financial position than you were in yesterday.
Ah, I see. I'd be making a profit in the form of a better house.
Exactly. So they calculate the current replacement cost, and then they subtract the depreciation to find the actual cash value.
Wait, but if indemnity limits my payout to the depreciated value, why do so many homeowners buy replacement cost policies? Does getting a brand new item instead of a depreciated check violate the rule of indemnity?
That's a really good question. It is a slight variation, but it actually still honors the core principle. Replacement cost policies, which, they pay to replace an item with a new one of similar kind and quality today, they still aim to restore without enriching.
How so?
Well, you might get a new television to replace your 5-year-old one, which is functionally a slight upgrade because electronic stores don't sell 5-year-old TVs anymore.
Right, you can't really buy a used TV from Best Buy.
Exactly. But you aren't getting a TV plus $10,000 in cash. The goal remains functional restoration, not a cash windfall. But ACV is definitely the purest mathematical application of the rule. Adjusters also use things like policy limits, deductibles, and coinsurance to enforce this ceiling.
Okay, let's pause on coinsurance for a second because that is a massive hurdle for anyone studying this material. The phrase itself sounds like you are sharing the insurance with another company, but it is actually a mathematical penalty for the policyholder, right?
How does coinsurance enforce the ceiling of indemnity? Yeah, coinsurance confuses a lot of people. Let's break down the actual math of it. A coinsurance clause typically requires a policyholder to carry insurance equal to a certain percentage of their property's total replacement value. It's usually 80%.
Okay, so let's say my commercial building is worth $1 million. To avoid a penalty, I must carry at least $800,000 in coverage.
Right, exactly.
But let's say I want to save money on my monthly premiums. I decide to only insure the building for $400,000, assuming, any fire will probably be a small contained fire anyway.
Okay, well, if you do that, you only carried half of the required amount. You carried $400,000 instead of the required $800,000, so you are 50% underinsured.
Right.
If you then have a $100,000 fire in the kitchen, the insurer will not pay the full $100,000.
Even though I have $400,000 in coverage.
Exactly, because they apply the coinsurance formula. It's what you carried divided by what you should have carried multiplied by the loss. So 50% of the $100,000 loss, they only pay you $50,000.
Oh, wow. So the coinsurance clause actively forces me to share the loss out of my own pocket because I tried to game the system by underinsuring.
Precisely.
It prevents me from recovering my full loss unless I pay the appropriate premium to support the collective pool.
Yeah, it enforces fairness. You cannot pay a fraction of the premium and expect full indemnification.
That makes total sense. So let's look at another concrete example of sharing the loss, specifically with deductibles. Because we have an auto claim scenario from our sources that illustrates this perfectly. Let's say we have a driver named John.
Okay, go on.
John owns a 5-year-old vehicle.
Ah.
The current market value of that specific car, as it sits in his driveway, is $15,000. John gets into an accident, and the mechanic says the repair cost to fix the damage is $12,000.
Got it.
And John has a $500 deductible on his auto policy. So if I'm doing the math as the adjuster, I look at the $15,000 total value of the car, I subtract the $500 deductible, so the insurance company writes a check for $14,500.
Not quite. Remember the core rule here. We are indemnifying the actual loss, not the total value of the item. The loss here isn't the entire car. It is just the repair bill.
Ah, I see where I tripped up.
Yeah.
The loss is strictly the $12,000 for the repair.
Right.
So the adjuster takes that $12,000, subtracts John's $500 deductible, the insurance company pays $11,500, and John pays his $500 out of pocket directly to the mechanic.
Exactly. And look at John's financial position at the end of this transaction. His car is fixed, he is restored to where he was, minus the deductible he contractually agreed to share when he bought the policy.
So he didn't make money.
Right. The insurance company didn't hand him $15,000 just because that is what the car is worth. They paid exactly what was needed to put things right, minus his share. John receives a functioning car, not a profit.
But wait, what if the accident was completely the other driver's fault? Say someone ran a red light while texting and T-boned John. John gets his $11,500 from his own insurance to fix the car. Since the other driver caused the damage, can John take that guy to court, sue him for the $12,000, and just pocket the cash?
Well, if he successfully did that, he would be paid twice for the exact same accident. He'd get the money from his insurer and the settlement money from the at-fault driver. He would literally walk away with an $11,500 profit.
And indemnity strictly forbids profiting from a loss.
Exactly.
So how does the system legally stop him from double-dipping like that?
Through a standard policy clause called subrogation.
Subrogation.
Right. Once your insurance company indemnifies you, so once they pay the mechanic to fix your car, they legally step into your shoes. They take over your right to sue the at-fault driver for that specific amount.
Man, subrogation is like the insurance company tagging themselves into a professional wrestling match. Like, they spot you the cash to fix your car to get you safely out of the ring, but then they step into your shoes, take your legal rights, and go hunt down the at-fault driver to get their own money back.
I love that analogy. That is exactly the action taking place. They recover the costs from the responsible third party, and this accomplishes two brilliant things at once. First, it holds the at-fault driver financially accountable for the damage they cause to society.
Right.
And second, it strictly protects the principle of indemnity by ensuring John doesn't double dip and turn the accident into a payday.
So if you are an adjuster listening to this, or you're staring down the barrel of a CPCU exam right now, specifically the CPCU 500 on managing evolving risks, or the 520 on insurance operations, these mechanics we just discussed are the exact distinctions test makers use to trap you.
Oh, absolutely. They love testing this.
ACV, coinsurance penalties, subrogation rights. Our sources actually highlight a few major misconceptions that constantly trip students up.
Yeah, and the first major trap is the assumption that indemnity guarantees full reimbursement. People often think restored to the same financial position means walking away without losing a single cent. It absolutely does not mean that.
Well, we just saw that with John's auto claim. He was still out $500 for his deductible.
Right. The principle of indemnity is entirely focused on establishing a ceiling. It ensures you do not profit. It does not guarantee you won't suffer a financial loss. Your actual coverage is always dictated by the terms of the contract.
Okay, so deductibles force you to share the loss. Coinsurance clauses mathematically penalize you if you underinsure.
And policy limits put a hard, unyielding cap on the maximum amount the insurer will pay out, even if your actual loss is $1 million higher than your limit. And of course, exclusions mean some losses simply aren't compensated at all. Indemnity acts as the ultimate ceiling on what you can recover. But the specific details of your policy often set the actual payment significantly below that ceiling.
So indemnity is the ceiling, never the floor. But let's look at the second major trap, because this is the one that forces a complete paradigm shift. The rule states, property and casualty insurance are contracts of indemnity. But life insurance is generally not a contract of indemnity. Life insurance operates as what is called a valued contract.
Yes, very important distinction.
But wait, if property insurance strictly relies on calculating the actual cash value of a loss to prevent overpayment, how do you mathematically value a human life for a life insurance policy without violating this golden rule?
The answer is rooted in the limitation of economics. You simply cannot objectively measure the financial value of human life. It is fundamentally impossible.
Yeah, that makes sense.
You cannot calculate depreciation on a person. You cannot run an actuarial formula that perfectly calculates their exact economic, emotional, and structural value to their family in a way that perfectly replaces them after a tragedy.
Because attempting to calculate the actual cash value of a parent or a spouse would be, well, practically impossible, not to mention incredibly morbid to even attempt.
Precisely. Because you cannot measure a human life's exact economic value post-loss, life insurance abandons the indemnity model altogether. It doesn't look at a death, tally up the exact financial loss to the penny, and try to restore the family to their previous financial state.
So what does it do instead?
Instead, it utilizes a valued contract. When you purchase the policy, you and the insurance company agree upfront on a specific, predetermined face amount, let's say $500,000.
So the value is completely decoupled from the actual financial impact of the loss. If the insured person passes away, the company just pays the pre-agreed $500,000.
Exactly.
It doesn't matter if the deceased was earning $1 million a year or $0 a year at the exact time of their passing.
That is the core distinction. Property insurance is a contract of indemnity because we can accurately calculate the value of a sedan or a warehouse after it burns down. Life insurance is a valued contract because the value must be agreed upon before the loss, since a human life is fundamentally immeasurable. Test makers love to see if you understand why that philosophical distinction exists.
And that distinction is the perfect bridge to synthesize everything we have unpacked today. If you need a single memory formula to take away from this deep dive, it is this: restore, not reward. Insurance exists to compensate for a loss. It does not exist to create financial gain. It is designed to make you whole, not wealthy.
And understanding that isn't just about passing a licensing exam. Whether you are an adjuster having to explain a settlement check to a frustrated homeowner, or an actuary running standard deviations to price a new product, or just a consumer wondering why you can't insure your laptop for 10 times its value.
Right? Knowing this principle unlocks the why behind the entire system. Indemnity is basically the operating system running in the background of the insurance world.
Once you understand it, you see it in every deductible, every policy limit, and every subrogation claim.
But before we wrap up, we want to leave you with a final thought to mull over or maybe debate with your colleagues. We spent a lot of time discussing actual cash value and how adjusters meticulously use depreciation formulas to find the exact financial value of a loss.
Right. ACV.
The goal is to perfectly restore someone without overpaying by even a single dollar. The math of indemnity strives for absolute scientific perfection.
It tries to strip away the emotion and look strictly at the cold, hard numbers.
But consider this. How perfectly can an adjuster ever truly measure the actual loss of an item that is highly depreciated on a spreadsheet, but holds massive, irreplaceable sentimental value?
Oh, that's tough.
Picture a vintage acoustic guitar you have played every single day for 20 years, or a custom dining table your grandfather built by hand. Under the strict rules of actual cash value, that item might be heavily depreciated. A mathematical formula might dictate it was worth $50. Wow. But the actual loss you experience, when it is destroyed in a fire, it is entirely irreplaceable. It serves as a reminder that while the mathematics of insurance strive for absolute perfection to uphold the principle of indemnity, valuing a loss in the real world, dealing with human beings and the things they cherish, will always be a highly complex art.
Very true.
Something to think about the next time you're staring down a claim sheet. Thanks for joining us for this deep dive. Keep studying, and we'll catch you on the next one.